Hey, thanks, Angie. And thanks everyone for coming out this afternoon. Also, welcome to the people online. I'd like to keep this fairly informal since we have a small audience and I think a much larger online audience, but feel free to interrupt as I go along because I've got quite a few slides to cover. And so it might be good just to nip things in the bud as they happen rather than wait till the end, although I'll certainly have time at the end as well. So just a little bit about myself, so you know where I'm coming from. I've been doing angel investing for longer than I care to think about, since 1982, when I sold my first business, which was a University of Waterloo spin-off company making video display terminals. Then in the late 80s, I came out to BC to run the Advanced Systems Institute, which was doing a lot of pioneering work in AI, machine learning, and robotics. And all the while I was doing that, of course, I continued my passion, which is angel investing and working with startups. I did a stint with Simon Fraser University, working in the commercialization office, which we turned into an innovation office. And one of the results of that was creating this facility, as an example. So that happened while I was at SFU. And also while there, we started Vantech, which is a monthly angel get together. In fact, the office for Vantech is right there. And also, I should mention the office for What If is also right there. We're kind of sharing space and do a lot of things virtually. So Vantech is as I'll tell you a little bit more about later, is an angel network. What If, on the other hand, is an angel fund. But the best part of doing what I do is interacting with, meeting with, and getting to know other angel investors. And I'm delighted that one real angel investor, Mark, sitting in the second row, has joined us today. That's a pleasant surprise. And thanks for joining us, Mark. He's going to keep me on my toes. He and I spent a lot of time comparing notes about things like safe documents and what we like and dislike about them. Of course, as far as they go, it's mostly dislikes, but you'll hear more about that later. So I'll jump right in. Wanted to just paint the picture of where we are today. There are a lot of market uncertainties, certainly stuff happening south of the border. We never know what's really taking place. So these uncertainties cause investors to be a little bit more cautious. And what that means for you is that probably prices are driven down a little bit. During the COVID years, we saw a flurry of activity in the innovation sector, and prices were pretty high. A lot of deals were getting done, a lot of capital was getting deployed, but that has changed as of late. There seems to be also more emphasis on metrics, on numbers, than the idea. The days are gone, I think, where you can write something on the back of a napkin and expect an investor to come along and give you a check. So people are more fixated on numbers and results. The last few years, of course, we've seen the pervasiveness of AI, and I think that's affecting everyone. It, I'm sure, has, and if not, will affect every one of you in the room. Dealing with AI is a challenge, how you embrace it. One of the impacts that it's had is especially strong on the software sector. We see companies like Claude writing code and doing things that might take a team a year to do previously can now be done in minutes by an AI agent. People that have no computing know-how or experience are writing agents. It's just amazing. We're seeing also, and this would be of interest to you, a bit of a funding gap. There is, and this is the good news, there's a lot of capital available to help you as startups get your business going. And there's a lot of capital once you're really doing well, but there's still that area in between where companies are struggling. And depending on how you define the different funding timeframes, you could call that post-seed, perhaps a little bit closer to Series A angel or Series A financing. But there is that bit of a gap in there, which won't affect you now when you're just getting going, but might affect you a little bit later. But the message that I hope you'll take away from this is that you can prepare for that now rather than wait until it hits you. We're seeing that there's also an aversion to funding capital intensive startups. So anything that in like clean tech is suffering from that a little bit. So if bioreactors are involved that are expensive, that's a bit of a challenge. So where a large amount of equipment is involved and funding for that is required, that's a little tougher than it was a few years ago. There's also bad news, a bit of a decline in VC fundraising, not VC investing, because a lot of VCs raised a lot of money a few years ago, and they're sitting on that to do follow-on rounds, but that's not capital that they can deploy in new situations. And they're finding a challenge in going out and attracting new limited partners to give them money that they can invest in growing companies. But the good news is there's lots of angels. Every time we have an exit, even small exits, it breeds new millionaires, people who, entrepreneurs like you someday, hopefully, cash in and now have a few $1,000,000 to deploy. And hopefully you'll become angel investors and put something back in rather than sitting on a beach somewhere. Like I say, don't hesitate to interrupt me as I carry along. Now, this slide, I have to confess, I've had this slide in here for over 20 years. Angie mentioned that I often give this talk. In fact, I've given a talk similar to this every year since New Ventures started. And I have this slide more or less every time. And cutting right to the chase, the reason I say today is a great time to start a company is it's because opportunities don't wait. And if you have a good opportunity, you should seize it now rather than wait. I was in a similar situation when I started my University of Waterloo company. I had 3 colleagues, 3 classmates actually. So there are 4 of us, students, and we started the company. I was a bit leaning towards academia. I had just done my master's in engineering, and I thought I want to do a PhD, not in engineering, but in business. And so I went to the University of Kansas and enrolled in the PhD program under a professor that I knew previously. And I was really having a great time down there. And right near the beginning, during my first semester, I got a phone call from my founder partners in Ontario. And they said, well, look, you know, we started this company, but you're down there in Kansas, and either you're going to come back here and help us make it work, or you should give up your shares and let us do it. Well, that was all I needed. And I packed up my bags pretty quickly, and I went back to Waterloo, and the rest is history. So we built a pretty substantial business that did trade globally, and took it public in the early 80s. And as I said, been doing angel investing ever since. But getting back to why you should start a company now, of course, it beats having a job. You might like working for somebody if you're an engineer or a scientist, lots of excellent jobs available to you. But if you're inclined to take a little bit of a risk, the neat thing about starting a company is that you're really writing the rules. You know, if you're trying to be the best at something, like if you're trying to be the best musician or the best NHL player, you have to play by those rules, and you've got stiff competition. But when you start a company, the neat thing is you can sort of define the rules for yourself. You can determine where you're playing, and you can determine a whole bunch of parameters around what you're trying to do. And if you do it right, you're the lone person in that space, and that's why you can win and do really well. There's a good article I'll refer to later, written by Regis McKenna, and it's in the Harvard Business Review. It's called Marketing is Everything, and it's a really good paper which deals with what I just addressed in a lot more detail. The crime rate today is pretty good. A few years ago, you know, it was up 7-8%. And what that meant was that people who might take risks earlier for a better return were now getting half decent returns just on more safe types of investments. There is a lot of capital, as I mentioned. One really good thing for you is that we have in Canada a lifetime capital gains exemption. Do you all know about that? Put your hand up if you haven't heard of it. Well, that's interesting. So here, this is really cool. You can start your business, and in 2 years or more from now, when you sell it, the first 1.275 million that you get is completely tax-free. You pay no tax on it. And that's going up a little bit each year. Last year it was 1.25. This year it went up to 1.275. So that's a really, really neat thing. And that's available to you as a Canadian corporation, Canadian taxpayer. We also have here in Canada, arguably the best in the world, low R&D costs, because you can get something around 70 to 80% of your money back if you do it the right way on your R&D expenditures. So you go and hire a scientist, you pay them $200,000 a year, you can get well over half of that back by claiming a so-called scientific research and experimental development tax credit. And that's easy to do. There's something like $3 to $4 billion spent by the Canadian government supporting this kind of initiative. And all you have to do is fill out the forms. It's not competitive. You don't have other people grabbing at the pile of cash that's there. Anybody who meets the conditions qualifies for that support. It's a great program. And in BC, there's a top up to that. That's how I got the higher number than the number that you might have heard. There's also an overhead proxy, which lets you gross it up even further. And then here in BC, speaking of British Columbia, we have something here which I don't think exists anywhere in the world. And I've traveled a lot and met with a lot of angel groups in many different countries and states. And what we have in BC is a government that will give angel investors like myself 30% back of whatever I invest in your company. So if I write a check to you for 100 grand, when I file my taxes, I get back $30,000. And that's not a credit in the usual sense. It's a refundable tax credit, which means that even if I owe no taxes, or even if I don't have to pay any taxes, I get that as cash. So it's as good as a certified check. And that's a great incentive for investors. And what it means to you is that if someone is willing to risk $100,000 on your company, they can now risk 140,000, because when they get 30% of 140, they're back to 100, but you've got an extra 40 and they've got more shares. It's a heck of a great deal. There are some jurisdictions, like I think Saskatchewan, for example, will have something similar, but it's not refundable. It's a tax credit that goes against taxes that you might owe. So the refundable concept is very unique. And I'm waiting for someone to jump up and say that they know a jurisdiction where there's something similar or better. I've not seen it. If you know of something or hear something, let me know and I'll change my tune. Yes.
But you have to invest in a BC company.
It has to be a BC company, yes.
But do you have to be a BC resident as the investor?
Yes, to get the tax credit, yes.
Right. So
there are some ways around that, but yes, generally that's correct. Okay, and my last slide here. No matter what you come up with, I'm sure you'll find a market for it in the United States, because Americans will buy just about anything, as long as it works, of course. Okay, access to capital. Let's talk about money. So, you'll probably all dip into your own pocket when you start out. And you might tap into close friends. You have to be careful that they are close friends. If they're not close friends, that's dangerous. And I'll tell you why in a minute. And of course, you've got relatives. You've got Aunt Sally, Uncle Joe. You might hit them up, maybe mom and dad. But, they can only go so far. And you might be a little bit nervous about hitting them up, because if things don't go too well for the company and you've got their money, it can create some family tensions. Then we have, of course, crowdfunding. And crowdfunding for products is really, really great because it validates your product, gives you confidence that you've got something that might actually sell. And it's a good way to raise money because a lot of startups raise money to create something. But if you can get that money from future customers, as is the case with crowdfunding, why not? And then, of course, we've got a new form of capital raising called equity crowdfunding. And that's relatively new. When I say new, it's sort of in the last 10 years. Before that, the doors were closed. You could not go to, say, the general public, like your next door neighbor or somebody like that, and ask them for money. It would be illegal. But that's all changed now. There are a few little hoops you have to jump through to qualify. But there are some platforms. Front Funder is a local, it was started locally. It's now, I think, based out of Toronto, but a local fellow started Front Funder, and it's a place where you can go and post your business idea and offer shares, for example, for sale to a whole bunch of investors. It's a little bit like how the Vancouver Stock Exchange used to be decades ago when it supported the mining sector, when shares were floated and thousands of people could buy shares for, not huge amounts of money, maybe $1,000 here and there, but 1,000 times 1,000 is $1 million. And that's the concept. You had a question.
I'm really happy that you mentioned front funder. I only heard about this about a month ago, so I don't know if anyone's in the medical device field, but legally you can't do any Kickstarter, things like that if you're selling a medical device. Unless you have regulatory approval, but you need that to get it. Anyways, equity is a fantastic way of getting funding, crowdfunding. That is not illegal. I was very concerned that investors would not like a cap table, so diluted by so many different minor investors. Do you think that the majority of investors would be okay with a cap table being so diluted by so many people?
It's a really good point. And for those who are online and may not have heard the question, it has to do with having a cap table with lots of investors and what are some of the issues around that. Dilution is not really the right word because you can have lots of investors. It's the amount that might come in and dilute you later. But to your point, VCs and other investors, even a lot of angel investors, don't like to see cap tables with gazillions of individuals on the cap table, especially when you need things like shareholder votes or decision making. It's a lot more difficult to chase 1,000 people than 10 or 20. And that's a problem. Now, to get around it, what is very common is to create a separate entity, usually a company or a partnership. It can be a number of different legal structures, but then you have one entity, and that one entity is a single shareholder in your company. And so when it comes to voting and decision making, you don't have to go to 1,000 people, you only have to go to one. So that's one way that companies have dealt with it. Robin, you had a question?
Yeah, I'm a shareholder at Front Funder. It's not for everybody, but they have figured out how to deal with the multiple smaller shareholders thing, I think, pretty well now.
It's a good point. Yes, Front Funder itself raised money from the public using the using the crowdfunding exemption.
Yeah, I'm happy to talk to anybody in the room about how Front Funder works. It's not for everybody, but if it is for somebody, it can work for everybody.
And if you'd like an expert, I see Aaron Stewart in the back. Aaron has joined me in Vantech and What If, but before that, he was working full-time at Front Funder. And so he can tell you from a very knowledgeable perspective, answer any questions you may have.
While we're recording this, I'm going to send this to Front Funder. It's not official yet, but they will be joining us as a partner.
Oh, good.
We'll be coming to speak about Front Funder to get your questions answered later in. Just wanted to, since it's topical, bring it up.
Great, thanks, Angie. And of course, even better than crowdfunding is non-dilutive funding from government. And our federal and provincial governments are really good at spending our money, our hard-earned taxpayer dollars. So we should all take advantage of that. You especially should take advantage of that. So if there's a program out there that can help you, take advantage of it. I mentioned the SRED program, but there's so many specialized programs. We have Pacific Can out here. We have support for Indigenous projects. We have support for women-led entrepreneurs. We have all kinds of buckets that you can go to. There was a company, another startup, started by Brianna Bailey, called Aaron, what was the name of Brianna's company? Pardon? Pocketed, yeah, the name just escaped me. It's called Pocketed, and they were taken over by Deloitte's just in the last year or so. And they were focused on helping entrepreneurs like you figure out the landscape in government funding, figure out what you could apply to, which may be very specialized and not right, on your radar. So there's lots of help like that available, and you should certainly take advantage of it. I mean, if you don't, I can tell you your competitors probably are, so it makes sense for you to just take full advantage. And then, of course, we have angels. And that's the subject of today's talk, and we're going to spend a lot of time on angels. Now, angels are also known legally as accredited investors. And here's the thing that's really important. When you sell shares, you can't just sell them to anyone. It's a highly regulated environment that we live in. And here in BC, for example, we have the BC Securities Commission. We have in every province a Securities Commission. It's actually one of my pet peeves about interprovincial trade barriers. And it's one of the first things we could get rid of, because if you're an entrepreneur raising money, if you're in BC and you're trying to raise money from investors in Toronto or in other provinces, you have to jump through extra hoops, and it costs you a little bit more time and money to get that support. So it would be nice to get away from provincial regulations and go with national regulations, more similar to what they have in the US, because in the US they have the Securities Exchange Commission, and they're the principal regulator. They do have state-wise institutions, but it's not like it is in Canada, where you have to go first and satisfy your provincial regulator. So whether it's in BC or across Canada, the rules are quite similar, but there are some nuances. So what the rules say is that when you sell your shares, you have to use a so-called prospectus. And a prospectus is like a business plan with a whole bunch of legal wording around it, wrapped around your business plan. And that's basically to protect investors, because these government agencies don't want unscrupulous operators to go out and say that they've got a wonderful startup and a great idea, raise a bunch of money, and then go south with it and not ever start a business. So these are all things that are done, to their credit, to protect investors, especially investors who may not be particularly knowledgeable investors, but it makes life harder for honest, hardworking entrepreneurs that need to raise capital. So you cannot raise money without a prospectus, which means you have to be registered with the commission. But there are so-called exemptions around that. So there are ways that you can avoid having to do this prospectus requirement. There are several, and I'm not going to go into them, but the one that we're talking about today that you can use is the accredited investor exemption. And what that means is that you can sell your shares to someone who is wealthy, because they can afford to lose their money and the government doesn't worry so much about protecting them, or to someone, basically someone who's wealthy. And that the definition of wealthy is either by income, so you have to be making at least $200,000 a year of net income, or sitting on liquid assets of over $1 million, not counting your house, because then everybody in Vancouver would probably qualify. So it's just your liquid assets. So just remember that, because if you have a friend, a classmate or someone that you don't know really well, in fact, there's a definition for that too by the regulators. But if you've just met someone and you've only known them a month or two, and they say, "Hey, I'll put $10,000 in your business," you can't do that, because unless they're wealthy and accredited, you can't do it. You can bring friends in, but only if they're really close friends that you've known for at least 2 years. So there's these little nuances, but just keep that in mind, because if you don't, here's the thing, you can probably get away with it. But let's say as you progress and you look for serious investors, they may look at your cap table, and if those investors on your cap table haven't been qualified properly through one of these exemptions, then you're offside. And other investors, especially VCs, or heaven forbid, company that's acquiring you and taking you over, will be worried about that. And then it can be a real nightmare for you if you don't pay attention to it. It's also illegal, but don't worry, you're not going to be put in jail for it. Here in BC, you'd only get slapped on the hands by it anyway, so not to worry.
Can you make that if you have someone that was somewhat not qualified as an accredited investor or right on the bubble or something, can you retroactively clear that up? Or so if it's like someone that's
I had a situation with one of the companies that I invested in, where they were raising mega millions of dollars, and one person was not properly qualified. And the bottom line was it cost them in the neighborhood of $50,000 in legal fees to fix it. So they did something retroactively. I can't recall what it was, but it's expensive. And they were able to fix it. But if you can avoid that kind of situation, and it wasn't just the expense, it really delayed things. They had investors chomping at the bit to write checks, and they were delayed because this had to be solved first. And I think it took, in addition to the 50,000, it took something like a month to solve it. Real pain in the butt, to be sure. Yes.
Sorry.
Oh, wait, was there a question more follow on online?
Yes, sorry if I may, but maybe after the in-person question.
Okay, go ahead.
Yeah.
I was just gonna say, I don't know if they can hear me online, okay, but government of BC also has just a downloadable accredited investor form, and then you can just use that, give it to them, and fill it out retroactively, and also post stop signing templates, that you'll get from a lawyer to have an investor already has a special take clause in it that does help assume the risk of the investor, stating that they are already an accredited investor.
Yeah.
Or meet one of these specified exemptions. So double check that the contracts that you signed don't already have that clause in it, because they might.
Yeah, I don't know if the online people heard that or not. It's hard to tell. But I think the comment was
It's a bit hard
basically
to hear.
a lot of resource information, a lot of material available around this subject. So, take advantage of it, read it, and be aware. Yeah. Anything else online?
Yeah, I'm sorry if I may. So, based from your experience, do startups usually have that ready, like the prospectus? Do they have that ready usually in case
Never.
they find funding, or do they apply for it once funding may get
Okay.
started in the negotiations?
Okay, let's just back up, be clear on the terminology. So a prospectus is a very specialized document, and none of you would have a prospectus. It just doesn't make sense, because it would probably cost you, I don't know, $10,000, maybe more, probably 10,000 minimum to get one. And you'd only get one if you're using a broker or an underwriter to take your company public or something like that. All that you would have is basically what you're going to do for New Ventures BC is a small, anywhere from 10 to 50 page document called a business plan. And that's all that you would need. And that's all that angel investors would ask you for. Did I answer your question?
Yes, but
Okay.
you mentioned that the document was for non-accredited investors, right?
There's
Or
no,
did I misunderstand? Sorry.
no. So you can't sell. The bottom line is you cannot sell to non-accredited investors unless you use another exemption. So you could use the crowdfunding exemption that we talked to. You could use family, friends, and relatives. Certainly your relatives, no problem at all. They can write you a check. And there's a bunch of others. There's probably 20 or 30 exemptions you can use, but they're somewhat esoteric and not particularly well known. But if you look it up on the regulator's website, you can find out what those are. Or you can just check with someone in the business, like a lawyer, and they can immediately tell you what you can use. But for all intents and purposes, for you guys, it's really accredited investors, family, friends, and relatives, and crowdfunding. And that's it. That's the main stuff. So let's talk about angel investors, and more specifically, business angels. Business angels are successful entrepreneurs, generally. People who have built a company, made some money, and now are interested in giving back by helping others go through what they went through, helping them with their business strategy, building a company, and of course, financing that company. So it's giving back time and money that defines investors. They also are really good mentors and coaches. They could be advisors to you. They could be directors of your company, which is a really good thing. And of course, more importantly, they are also accredited investors. And so by definition, they can invest in your company. I would point out that angels are not like venture capitalists. Venture capitalists are institutional investors. They make money by investing other people's money. So because they raise money from other people to invest in companies like yours, they have to be very prudent. They have to be very diligent. They are not investing their own money, so they have to be able to explain to their investors why they invested in your company. They can't just go by a hunch. They have to ask all of the questions why they should. They have to think of all of the reasons why they shouldn't invest in you. Whereas an angel investor tries to think of the reasons why they should invest in you. They don't look at the glass that's half empty. They look at the glass half full. And that's a really big difference between angels and VCs. The other thing is, of course, that angels can move very, very quickly. They don't have to get approvals from a whole bunch of other individuals in the organization. An angel investor, I've been in situations where I've decided on this in the same meeting to go ahead and invest in a company. Then in other situations, it may have taken months to come to that decision. And the other thing I would say about angels, again, unlike banks and VCs, is they're not homogeneous. So people like Mark, myself, we may have completely different interests and different pain points. And, one of us may be interested in really early, really risky. One may be interested in a little later. Some of us are interested in all kinds of technology, medical devices, clean tech, doesn't matter, bring it on. Others are very focused. They only want to invest in something that they really understand and know a lot about. So you get all these different attributes for angel investors. And that's good for you, because if you bomb out with a handful that you meet with, don't despair. Just keep knocking on more doors. Just try to find someone who is aligned with what you want to accomplish. So when you have your dream, your vision of where you want to go, just be honest, explain that to investors. And if you sense that they're not in that same space, if you're a biotech company and you're talking to somebody who only invests in SaaS companies, you're just wasting your time. So, know who you're talking to, I guess is the message there. So in terms of yes.
Well, last slide.
Yeah.
200K is before tax or after tax?
Net income before tax. So it includes all your deductions, your expenses, your allowances, that kind of thing. It doesn't include tax credits. So if you're a BC angel investor using those tax credits, they don't get deducted from your net income to qualify. But of course, you don't need it because you're a millionaire, and that's why you got them in the first place. Yeah, so it's 200,000 of it. It's you can see in my fine print here. I was curious, and so I checked with Statistics Canada. So 1.7% of Canadians qualify. It's a really small number. That's surprising. You know, we talk like right now we're going through, or soon to go through leadership campaigns. You know, we've got already people campaigning to be the leader of the Conservative Party here in BC and stuff like that. And I had a meeting with one of them on the weekend, and he mentioned that, you know, top of people's minds were things like affordability. And this is why, because housing is getting so expensive and income is so low. I mean, to think $200,000 a year and only 1.7% of the entire population, it's pretty tough. Which is a good reason why you want to be entrepreneurs and not work for somebody, I suppose. The other thing they mentioned, or that I found out, was if you take both the millionaire condition and the income condition, you combine them, it barely doubles the pool of available investors. You know, you're now up to maybe 3% of the population. And that's, I think, one of the reasons why crowdfunding came in, because so many people were really ticked off about that. They said, well, you know, who's the government to tell us what we can invest in and what we can't? We could invest in moose pasture mining stocks, you know, in the 70s, 80s, and 90s on the Vancouver Exchange. Why can't we speculate on high-tech companies and high-tech entrepreneurs? And that's, you know, why we have things like the crowdfunding exemption. So what angels want? I would say, number one, I got some actual hard numbers on this. I'm not sure where those numbers actually came from, but I think they're more or less correct. And Mark, call me out if you think differently. But you know, trustworthiness is number one factor cited by many sources, and it scored 4.81 out of 5, the highest of all criteria. Second was management team, number 2, you know, and that ranked 4.65 out of 5 in importance. And then other things like a compelling opportunity, you know, something that's really excitable, something that's 10 times better than anything else that exists. Having a CEO who's capable and coachable, you know, because one of the dilemmas that angel investors are faced with, you know, we meet bright young people all the time with great ideas, lots of enthusiasm and energy, but no business experience. And so the question is, what, you want me to write $100,000 check for you and you have no knowledge about business? That's a stretch. So as angel investors, we want to make sure that you are coachable, willing to learn, and that you'll do some backfilling where you are weak. You'll get advisors, mentors, and others, hopefully things like a hands-on board to help you overcome things that you are weak on. Of course, as angel investors, we like to make some money, because we're not just going to write checks forever and not get any returns, because that's not sustainable. So getting returns is really important, and I'm going to talk a little bit about portfolio returns, but typically we're looking at making anywhere from 10 to 100 times our money back. If your proposition is that, you know, write me a check and you'll make 5 or 6% or even 10% over the next few years, that's not very exciting. So it's got to be a huge multiple, especially given the risk that investors take. And the risks, of course, are extremely high. Another thing that's important for investors is for you to have interest from the market, having customers, keen customers, customers that are willing to buy your product, even if it's not available, willing to give you a purchase order. For example, when I had my business way back, I was in exactly that situation. And I was attracting investors who said, well, show me some customers. Well, I went to my alma mater and I said, why don't you give me a purchase order? Because I was motivated to design this product as a result of working at the university. I shouldn't say working. I was working as a teaching assistant, but I was really a student at the university. But I knew that they could be a customer for these products. And luckily, I was able to convince a professor and the purchasing department to give me a purchase order. And sorry about that. And that purchase order was enough for me to attract investors. And there's really nothing obligatory for a customer to give you a purchase order, because if you don't deliver the product, they're under no obligation to take it. So it was a pretty easy thing to do, and something, frankly, that I think I'd like to see more of. I don't see that sort of thing happening very often, but it certainly worked for me. But bottom line is customers are really important. Angels love it when there is a lineup of customers ready to buy whatever it is that you're trying to sell. And then what we want typically when we invest in your first round is to get a decent position in your company. If you're doing an initial round and it's your first time, a good rule of thumb is that when you're giving up, say, or when you're looking for somewhere between $500,000 and $1 million of investment capital, you'd be giving up somewhere between 20 and 30% of your venture. And so valuation comes into play, and we'll talk a little bit about that in a moment. We're also sometimes worried about what happens when you need more money. So we may be giving you enough to get to certain milestones, maybe get to certain customers, maybe get to a certain level of product readiness. But then what happens when you need more? Do you have a pathway to additional investors? And if you haven't thought about that really well, then what often happens is you'll be going out to investors at share prices much lower than where we came in. And so we worry about that, and we try to protect against that. Question.
Go ahead, Jim.
What are the differences that I should keep in mind when approaching an angel versus approaching a VC? Another question I have is for a pre-seed fund, what is the typical runway that an angel would look for?
Okay, let me take your first question. You probably. Yeah. Sorry, Mark. So your question was, first of all, why, maybe I didn't get it myself, why would you go for VCs versus angels?
No, what are the differences I should keep in mind when approaching an angel versus approaching a VC?
Basically, let me cut right to the bottom line on this. I don't think you should approach VCs. I think you're wasting your time if you're starting up. You may as well spend your time with angels, because it'll be far more productive for you. There aren't too many VCs that are interested in, especially in pre-seed startups. You'll find the occasional one, but I think you'll find yourself getting frustrated. Now, having said that, if you find some angels who can introduce you to some VCs because they are worried about what I just mentioned, follow-on rounds down in the future, then yes, it certainly is a good idea to cultivate relationships with VCs early on. But if your mission is to raise $500,000, say, to $1 million, then start with angels and don't spend too much time with VCs. Because as I mentioned, VCs will take a lot longer. They'll think of all of the reasons why they shouldn't invest, and it'll just be more frustrating for you. I hope that takes care of your question.
Yes, thank you.
Okay.
There are many VCs that claim to be pre-seed, but it doesn't appear to be that they are.
Yeah. And your second point was?
What is the typical runway that an angel would look for a pre-seed investment?
Yeah, so runway, you mean in terms of burn rate and how long the money will last until you need more money?
Exactly.
Yeah, so we like to see a year. minimum. We don't get that often enough, but wouldn't you say, Mark, about a year? Yeah, we like to see at least a year, and we like to see you raising more money at least 6 months before you run out. All too often, I see entrepreneurs coming to angels when they have like 1 or 2 months of burn left, and that's very dangerous. It's a real, and it's also a turnoff to investors because it shows a lack of financial acumen or planning on your part. So I guess a good rule is as soon as you've raised money, think about your next round and already start raising it before you even dip into what you've raised on your initial round.
Thank you.
The other thing that we like to see, the last thing on this slide, is a shareholders agreement. That's what I mean by SHAG. It's important for you, and I can talk a few minutes about a shareholders agreement. It's important for you to have one. Investors like to see it, and one of the conditions they like to see in a shareholders agreement is that there's some form of so-called reverse vesting. Because keep in mind that we as investors, we're putting up cash, and for that we're getting shares. You as the founders are putting up a dream, a future, in exchange for shares, right? Now, what happens if that dream becomes a nightmare overnight and you quit? And I've seen this over and over again where there might be a group of founders, maybe 3 or 4 in a company, and 1 or 2 may say, this entrepreneurship stuff isn't for me, I quit. And they have all these shares. You've got to have a way to get those shares back, because those shares have to be available to those people who are going to join you to replace those people who've quit. So if you, in your company, have partners or founders with a lot of shares, those should be earned. And you would have an agreement which says something like, if you quit after 1 out of 5 years, you might only get to keep 1/5 because you've only earned it by working hard for 1/5 of your commitment. But if you leave, then 4/5 of those shares go back to the company and they can be used to recruit the quitter's replacement. So that's a really important thing. And speaking of shareholders agreements, especially if there's a very small number of you, and the most frustrating situation is where there are 2 founders. And I see this regularly, and I'm not exaggerating. It's not a rare occurrence. It's a very common occurrence where 2 people have a falling out. I mean, remember, it's like a marriage. You and your partner are married for business. And, we know that in families, divorce rates are around 50%. I'm not sure what they are in founding partners, but I'm guessing they're probably 50% or even worse. So what do you do in that situation if you each have exactly 50% and you don't have something in your shareholders agreement where you can buy each other out somehow? You're going to be in big, big trouble. There was one of our new ventures winners. I won't mention who it is. It was also an SFU student. 2 of them, they started a company which today is very, very successful. And they, after being partners together for something like 10 years, they just went through hundreds of thousands of dollars of lawsuits and legal expenses to solve that very problem. They each had different ideas of where they wanted to take the business. They each had 50%. They couldn't resolve it. They had to get lawyers and courts of justice to help them figure it out. So you can avoid all those headaches with a shareholders agreement. And don't get me started on it, but I'd be happy to point you to lots of good resource material on shareholders agreements. It's also important to understand angel motivations, and very important, motivations beyond financial returns. Because I personally don't think that angel investors are in it just for the money. Because if they were, there are lots of other options that they could be pursuing. But this says that, what's the number there? 37% are motivated by giving back, helping others go through what they've been through. You can see here in the pink slide, the return on investment is important, but it's only 60% of the picture. Then mentoring is about 15% and 21% for building companies. In my own situation, when I exited from my business, you know, when you're an entrepreneur, you're working 7/24, 365. There's no breaks, no family time, you know, you're absolutely committed. And so when that's all over and you're lucky enough to sell your business, you think, maybe I should take a little break. And that's how I felt. I was, you know, in my early 30s, I thought, geez, I'd like to do something a little different. Although there's always that urge to do something new, to start another company. My wife, kids had little something to say about that, I must admit. But the good way to do it, the way I did it, was vicariously. I thought, well, gee, if I invest in a bunch of people, young people, who full of ideas and enthusiasm, that's like me doing it, except I'm not the one where the buck stops. I'm the one that goes to you and says, how's it going? How are sales this month? How are the revenues? You know, but it's not me that has to worry about that and lay awake at night. So I think a lot of angels are in a similar category. What else have I got there? Oh, and the other thing to keep in mind is that generally speaking, angels are pretty smart. You know, they're not dumb people that you can fool with a fancy business plan. They'll dig deep, do a lot of due diligence, do a lot of fact checking. Highly intelligent, wealthy, motivated individuals, in short.
So founders, just that one slide before.
Solo founders?
Yeah, I know it's kind of contentious. Everywhere I read, something says something different, and I wondered what your opinion was on that.
Whether angels like solo founders?
Yes.
Often, yeah, it usually starts there many times, but we like to see a pathway to building a team because you can't do it all on your own. Highly unlikely, unless you've got something like a breakthrough patent where you're really building a business around the patent and selling the business because it has the patent. That kind of thing might work. But if you're building an enterprise, you need company, you need others to work with you. So for us, you're the most important part, you're the starting point, but we like to see a plan for growth and scaling. That's fine. Yeah, for those online, does it matter to have a lot of employees versus founders? Many companies got started with just one founder who went out and just hired people. There's some really good examples of people who have retained 100% ownership of their business. If you can do that, actually, that's a good thing to do. I shouldn't say that because I can't invest in you then. But if you can get away with, hiring good people. Jimmy Pattison, one of our, probably the best known, most wealthy entrepreneur in British Columbia, that was his philosophy, hire good people. I had dinner with him one evening and I took the opportunity to say, it's funny because in my world, it's all about bringing in employees as founders, making them partners, giving them shares, having them participate in the company. And I said, and Jimmy, you're the opposite. You like to own everything 100%. And he said, well, that's my philosophy. I believe in hiring the best and paying them top dollar. So it's a mindset thing where you come from. So I think both work, but it comes down to you. Okay, moving on. Some business model essentials and what angels evaluate and what angels look at. I'm not going to spend too much time on this, but and these are sort of, as you can see, almost equally weighted. But the one I do want to point out because it speaks to valuation and other issues is exit. And most of you probably aren't thinking about an exit. You're thinking about getting started, not cashing in. But for investors, that's really important because think about it. You're getting money from an investor and that investor is going to want to see some payback sometime on that money. And what's that time frame? you know, if you're an older investor, you know, if you're sort of at my age, you may not be keen on someone that says you're going to get paid out in 20 years. You may not be around in 20 years, right? So that could be a problem for you. So you want to know about the exit, but more importantly, you want to know not just about timing, but what is your company going to be worth down the road? And when and who's going to buy you? You know, is it Google? Is it going to be an oil company? Who's going to take you out at some point? And you should be thinking about that early, because that's what investors are thinking about. When you first engage with an investor, and this is true for VCs and angels, it used to be the case where angels weren't too fussed with this, but increasingly they are. And that's something called a term sheet. And a term sheet is basically a summary document which outlines all of the conditions of an investment that an angel might make. And you can get on both my website and on What If's, on a bunch of websites, you can get examples of these term sheets. But it's sort of the rules of engagement, so that if I, as the angel, am going to write you a check, in return for that, before I write that check, what are you going to promise me that you're going to do? So it's things like the price. What is the price that I'm paying for my investment? The price per share. What am I getting for that investment? Are you giving me a debt instrument, or are you giving me equity in the company? What's the amount that you're seeking? Are you on side legally? Like, and this is where the qualification comes in. Am I and all your investors properly qualified? And are you authorized to do what you're doing? So there's a whole bunch of these things. I mentioned vesting before shareholders agreement. Cap table, very important to have a cap table. That's really like a share register. It's a summary share register which lists everybody that owns your business. So having all of these things identified when you first engage with an investor, very important. One of the things that is hard for angels to come to grips with is writing a term sheet. And many angels shy away from this. So they look at either angels that are more active, like very active in doing angel investing as a business, or perhaps funds, small funds like angel funds, which I'll talk about, in writing the first term sheet. Because once you have a term sheet, then that's a mechanism for bringing other people in. So if, for example, Robin, you and I agree on terms of investment, then you can take that term sheet and you can talk to other people and say, well, look, you know, Mike's going to invest under these terms. So he's done some checking and he's happy with this. And it really helps you take that next step with another investor. This is one thing that angel funds are pretty good at doing for you. So let's talk a little bit about valuations. So by valuation, I mean is what's your baby worth? What's the value of your company? Because if you're raising $1 million from angels, after you've got that million, how much do the angels own in your business? So usually you come at it from a starting point. You might say, well, today we think we're worth $2 million. We're going to raise $1 million from you, the angels. So you get a third, because now you have $3 million. You've got the $2 million that you've earned through your sweat equity, got $1 million of cash there. Now $3 million. You own 2/3, your investors own 1/3. So that valuation, coming up with that number, is the number one challenge for entrepreneurs in any negotiation. And you can come up with a number in a gazillion different ways. But for what you have to think about is, what are the investors thinking? You know, you might rationalize it, well, we got all these great patents. We've got, these wonderful employees. We've got customers. And we've got this cash flow, this projection, how our sales are going to be $50 million in 5 years. You know, you're dreaming and maybe you're hallucinating a little bit, but you're thinking like that. And so really it comes down to a starting number. However you get it, you're going to have a starting number. But on the other side of the table, the investors are going to be thinking, I think, from my opinion, first and foremost, about what it's going to be worth when you exit. And is that a number that they can accept or appreciate? And is it a meaningful enough number for them to take the risk today? Are they going to get the returns? Because it does come down to returns. You know, having fun with the startup is great. Mentoring, learning, that's all good. But if you don't have returns overall, you're going to stop being an angel investor. So that's really, really important. So let me give you a valuation example. And I'll use a New Ventures BC winner. So in 2013, this company had an attractive valuation, certainly attractive to me, and a valuation that I bought into. And it was a 1.5 million pre-money valuation. So before raising any money, it was worth 1.5. Now to get going, they needed only $300,000. So a bunch of angel investors gave them the $300,000. So their valuation now is 1.8 million. Sounds decent. Everybody was happy. Now, fast forward, they had an exit just 5 years later. That's pretty good. 5 years for an exit. That's better than average. Something we like to see. And the exit was $26 million. So you think, gee, that's 17 times your money back. But did I get 17 times my money back? No, because of dilution and many multiple rounds of investment. So going back to my previous comment, when you look at an exit value, it's not just that you're going to make that multiple, you have to factor in the washout that occurs between that starting point and ending point. So what this company did was they raised lots of money. Like they didn't just raise the 300. I think, I forget how much they raised in total. Oh yeah, I've got it on there. 11 million. They raised $11 million after they raised the 300,000 angel money. So it was really great because the angel money got them to that point where they could then attract these other investors. But those investors all drove a pretty hard bargain, and the valuation didn't go up very much. So, you know, I mentioned it was 1.8 million. So maybe then the next round was at 2 million. Then they raised $1 million. Now the valuation's at 3 million, and so on and so forth. So the share price never changed a lot. You know, so let's say our share price was, I think it was 25 cents. I think by the time we got to the exit, it was close to 50 cents. So that's why we just doubled our money. So investors didn't do super well. Now, one way to get around that is you can do things like have liquidation preferences, and I'll mention those in a moment. And in fact, we had that in this example, so it was not that bad for angel investors. But these are the kinds of things you should be familiar with, because these are the things that angel investors are thinking about before they write you that check. Let's talk about investment instruments. And, you know, if you have the right instrument, it's music to an angel's ears. The thing that angels don't like, and I'll start with the worst case scenario, which is number 4 on my list, is a safe. Does anyone not know what a safe is? At this point, have you all heard of safes? Don't be ashamed if you don't know. If you don't know what a safe is?
No.
Okay, thank you for that. Thank you. So a safe is a simple agreement for future equity. It's something that is very popular. Aaron and I look at dozens and dozens of proposals from entrepreneurs. And Aaron, what percentage are we getting that are safes now? More than half initially? How many?
75, 80%.
It's getting that high, isn't it? And as insofar as we really dislike them, they still keep coming at us. And I think the main reason for that is because they came out of an accelerator in California called Y Combinator. And the thinking was that you don't like to come up with a number. You don't like to set a valuation. So instead of, fighting with an investor and wrestling with that question about what are you really worth, that is postponed. And the way that the safe works is, well, give me money today and we'll figure out the price tomorrow. When a real investor, not that we're not real investors, but when a serious investor, like a venture capitalist, comes in at a serious seed round or Series A round, because those bigger investors, after all, they know what they're doing and they've got millions of dollars to invest, and they're going to negotiate a decent price for themselves on that subsequent round. And what the safe will do is give us that price with a discount. So if you're selling to those investors later on, after selling to us on a pre-seed round, we get a 20% discount. And 20% happens to be, it's another pet peeve of mine, 20% happens to be sort of the norm. And I think it sucks, because I think for investors taking those big risks, the discount should be more like 40%. But it's not happening. And frankly, if you can get away with it, go for it. But people like Mark and I and Aaron, we keep pushing back on that as much as we can. And we don't like safes. And I'll tell you why. Because safes give us no security. There's no security at all. They don't give us any vote or any say in what's happening in the business. And what you can do, and this has happened, in fact, is you can just say, screw it, we quit. And you can take that money and keep it. And there's very little that we can do about it. And this goes back to the very first thing that angel investors are looking for, and that's the trustworthiness. And are you trustworthy? But investors do get fleeced by people who come across as trustworthy and aren't, and it's actually a concern, and it actually happens. And there's a whole bunch of other things around safe that we have actually a blog on the What If website that you can read, and we have something called the safety, which gets around that. And what the safety says is, pick a price, pick a number. We'll go with that number. And then when you do your next round, if you're selling at a better number, then we get an adjustment in how many shares we get. And it essentially accomplishes the same thing as a safe. But in the meantime, we are actually a shareholder in your company. We're just not out there in no man's land as a quasi debt holder. In fact, FINRA, one of the financial institutions, they, in one of their investor beware cautions, they don't even consider safes as real debt instruments. They consider them as quasi equity and not real debt. So you have very little to say as an investor if all you've got is one of these loosey-goosey safe instruments. Now let's jump to the top. That's what we don't like. What we really do like is convertible participating preferred shares with a liquidation preference. Would you agree, Mark? Is that what we really like?
I don't mind safes at all.
Pardon?
I'm very happy with the safe.
You're safe. You don't mind them. You've learned to live with them.
Standard post money safe.
Okay, but would you prefer a convertible preferred?
Not necessarily, because I think in the long run, that's what you typically end up with once the safe converts. So my view of it is, as an investor in an early stage company, all we get is a piece of paper that really gives us some participation in a good outcome, aka access. And the form of the piece of paper, I'm quite agnostic on. If the company is successful, we're going to make money regardless of what the form of the piece of paper is. If the company fails, we're going to lose our money regardless of what the form of the piece of paper is. So I'm way less concerned than what you say about what the form of the piece of paper is, other than I agree that common shares are less desirable, but your safe typically converts into preferred shares. So you get,
And what happens if you don't convert?
doesn't matter,
Because
Because
the company's toast, right?
which case if you own shares.
Okay, so back to, so that, it's really good to have this discussion and to have a different opinion. But what you're saying is that trust is really important in the first instance, right? And then, and what you're also saying, and I'm reading into the lines here a little bit, but you've got a portfolio because you do a number of investments. And so you know that some are going to fail and the winners are going to carry the losers. So you're not going to be too obsessed with what these instruments might be. Is that a fair comment?
Like you, I don't like common shares because there's many rights that go along with pref shares that you want. And the safe converts into pref shares, so you're gonna get those rights.
So for the entrepreneurs in the audience, it's just important for you to understand these instruments. For some people, they'll be more important. Like for me, they'll be more important than they will be for Mark. And I think that's why they exist, because again, angel investors have different opinions, different styles, different preferences, right? So one investor may be completely comfortable with the safe. Another one may be at the other end of the spectrum and want something really rigid, right?
There's only one more comment I would add. You're right, in the safe, one thing you don't get as an investor is voting rights.
Yeah.
I say, like, doesn't matter, right? I don't, I don't care whether I have voting rights or not. I'm not owning 25% of the company. Don't care whether I have voting rights or not, doesn't matter.
I guess the vote, you're right. I mean, it depends on how much you're putting in.
Yes.
Like so often, so on that subject of voting rights, often, and as you've seen when we do a round, like with a term sheet, you get a group of angel investors, and as a group, they might want to have some say, like who's on the board of directors, right? So that's a vote, right? So you want to have some influence on who's on the board of directors. So things like that. So it gets a little bit more nuanced and subtle, but it's an important point. But anyway, I thought I'd mention this because there is controversy around things like safes and the types of instruments that you'll get in. Going back, let me give you an example of here where the convertible preferreds were important. So in this example, where the investors got only 2 times, those angel investors that came in at the very beginning, they actually got 3 times their money. And that's because they had the equivalent of a participating, of a liquidation preference. And what that said was that they got their $300,000 back before the rest of the money was divided among everybody else. And again, when this company got started, it was so difficult to get that first $300,000. And Mark, I don't think they certainly would not accept a safe from investors. But what investors said was, this is so risky and so early, we'll give you the money, but because there may be all these additional rounds down the road, we want a bit of a sweetener for taking that early risk. And it was that form of liquidation preference. So I mentioned that the exit was 26 million. So for the founders, they took the 26 million, took 300 off the top. That leaves 25.7 million. The 300 went to the angel investors. The other 25.7 was divided among everybody else. So the angels got their 2x out of that, but they got that additional 1x. But it worked. It worked, and it's an example of how you can be creative. Something else to make you aware of, some angel investors are more obsessed with this than other angel investors. And And it has to do with so-called asset classes. When you look at all of the options that are available to an investor for deploying capital, there are many places where we can put our money. We can invest in real estate, we can invest in bonds, we can invest in hedge funds, we can invest in cryptocurrencies. There's all kinds of places where we can put our money. Now, if the number one thing of importance to us is the return on our investment, then this becomes important. One of the safest and best returns, in my personal favorite benchmark, is the Royal Bank of Canada. The Royal Bank of Canada, for the last 30 years, has given investors an excellent rate of return. It averages better than 15%. It's somewhere around 16%. So if you're an investor, if you're one of those angel investors, or not an angel investor, if you're an entrepreneur who's just exited his company and you're trying to decide, should I take this $1 million and put it into the stock market, or should I take this $1 million and put it into startups? And you see that you can get Royal Bank types of returns, you put it in Royal Bank, right? And so when I look at investing in startups, I'm thinking that number has to be beaten. So it's a good sort of stake in the ground to think about. And when you give your pitch to investors, you're often going to be talking in terms of multiple. Well, you'll make 10 times your money in 5 years, or 5 times your money, whatever. And what the investor is ultimately going to absorb is, what does that mean to me in my portfolio in terms of internal rate of return? So here's some numbers as an example. So if you double your money in 1 year, that's a hell of a good investment. I'll take that any day. But if you're talking about 10 times in 10 years, and that's that blue line there, that's the pitch, the proverbial entrepreneur pitch who says, you're going to make 10 times in 10. How many times do we hear that, Aaron? Just about every pitch refers to 10 times in 10 or better, right? In some form or another. But that 10 in 10 seems to be kind of a placeholder. But that means 26% internal rate of return. Sure is a heck of a lot better than Royal Bank return if you invested in Royal Bank. But remember, that's on one company. And angel investors only make money overall if they invest in lots and lots of companies. There was a very famous seminal study done a number of years ago by a researcher in Washington who looked at angel investing throughout the US and Canada. And he found that for angel investors to beat those kinds of 15% numbers, you had to have a portfolio of well in excess of 20 companies, because so many are going to fail and you need those outliers to improve your overall rates of return. So 10 times in 10 sounds good, but it's a portfolio approach that investors are taking when they look at these numbers. So I see we're moving on time-wise. Where do you find these angels? The good news is they're right there. They're right in that office next door. And in fact, this week on Wednesday, we have a Vantec angel meeting managed by Aaron at the back. And you're all invited to attend that. You can certainly attend it online. It's very easy. If you feel like it, talk to Aaron and maybe we can have a seat for you to come in person. That's this Wednesday. It's a good experience because you can hear other pitches. You can hear questions from angels. You can hear how diverse their questions are. And that takes place here every month, except in the summer. There are also other forums. There's Angel Forum, which takes place every couple of months or so. There are other groups and organizations. A really good way to meet angels is through New Ventures BC. The networking event tomorrow afternoon is a wonderful way to start to meet mentors and other angel investors. We also have here in BC Angels on Steroids, and that's the Keiretsu Forum. So these are angels who are, for lack of better word, a little more deep pocketed, a little bit more serious, a little bit more committed than your average angel investor. These are people who spend almost their full time doing angel investing, and they attend events like the Kretsu Forum, which is an international angel organization. So if you're raising Series A or Series seed money, that's a good organization to go with. And then you can get investors from across the Pacific Northwest. It's just a bigger deal. I think of Vantech as kind of the farm team, and Kretsu is kind of the big leagues, more like the NHL. But it's good that they're there, and it's good that you are familiar with them, and it's good that you get exposure to investors that attend these different events. We also have angel funds, and I'm going to blow my own horn here a little bit. I started a fund over 20 years ago, and there were two reasons for that. One was a personal reason. I felt that, if I invest 20,000 here and 30,000 there, I can never have any say or any negotiating capability with the target investment. So I thought, well, if I get a bunch of buddies together and we pool our capital and we work together as a team or as a fund, then we have a little bit more clout. And we can do things like term sheet. We can lead around by writing a term sheet. And so that was one of the concepts behind it. The other reason for forming a fund was so that we could get a whole bunch of other investors, new investors involved, people that don't have the time to build their own portfolio, people that don't have the wherewithal or the resources to get 20 or 30 companies in their portfolio. By investing in funds, they indirectly invest in a portfolio. So these were the kind of the driving factors. And today, What If, for example, has grown substantially. We just raised in the last month, we raised an additional 3 million from angel investors. And we have that now sitting in a bank account ready for you. And so talk to us. What we worry about, what Aaron and I worry about, is FOMO, fear of missing out. We don't want to miss out on the next big thing, on the next great opportunity. So don't hesitate in coming to us. So there's a little pitch from me to you to not forget about us. Don't leave us out in the cold. We like to get in on winning companies and make money just like everybody else. All righty. Last couple of slides. We're almost done here. I want to leave you with a few thoughts here. Ultimately, whether it's for you, investors, your banker, VCs, it always comes down to making the business case. And this isn't always the easiest thing to do, but in a certain way, it's quite simple. It really comes down to, what are you selling? You have to articulate that. Don't talk about your technology, just talk about what it is you're selling, the service or the product, who's buying it, and ultimately how you're going to make money. And it sounds easy, but that's what is important to investors. That's what they want to hear. And, you've probably heard of something called an elevator pitch, and that's where in a sentence or two, you really answer these 3 or 4 questions in a sentence. But when you look at this from an investor's perspective, what we don't see is the investor pitch. And it's just as easy as coming up with the elevator pitch, but it has more to do with the returns and what's in it for the investor. So, selling the investor on the idea of your company is great, but you also want to sell the investor on what's in it for him or her, right? So you want to say something like, Ace Corp, we're asking you for $500,000. We need that for production tooling and hiring some sales staff. In exchange for that, we're going to give you 20% of our common shares. And the way you're going to make money is by us selling out to a company like Polycom, because they're in our industry, and we're going to sell out to them for $15 million. a few years from now, and that's going to give you a 6 times return in 6 years, which equates to an IRR of 35%. So something like that, not necessarily that concise, but along those lines is what investors are looking for. And just for fun, and I was going to delete this slide, but I just couldn't bring myself to deleting this slide. When we have these angel meetings, we like to play something called BS bingo, because we don't want you to BS us. And so we say to the investors in the audience, if you can make a bunch of X's and score a line before the presentation is finished, the presenter has to sit down, and that's the end of the pitch. And this is to keep you from being too hyperbole oriented and hyping your venture too much. Stick with the basics, be humble, be honest, tell us what you're trying to do, and convince us with straight, simple talk. Of course, everybody has AI in their slides now. Goes without saying. Now, getting to the competition, and this is where I'll just stop. I've got a whole bunch more slides, but I don't go into those here, but they're there for you to access either from New Ventures or my website. And they're just there to kind of help you think a little bit about questions that angels are going to ask you at some point or another. As far as the competition goes, it's really the same as what you're going to be talking to angel investors about. And think about it. A lot of the judges, a lot of the mentors in New Ventures BC are angel investors. So you kill 2 birds with 1 stone by getting your message right, not just for this competition, but for investors in general. You know, the prize money is great, and that's free money. You don't have to give up any save. You don't have to do a save or give up shares for the prize money. But for those of you who don't get the prize money, and even those of you who do, there's going to be a lineup of investors who want to learn more about your company and invest. Our What If Fund has invested in many of the New Ventures companies, and not necessarily just in the winners. So the prize is not just the prize money, but it's that access to angels and angel capital. And I'll leave you with these words. There's no substitute for P&L. And by P&L, I don't mean just profit and loss, which of course is very important to VCs, more important to VCs than angels. But what's more important to angels is passion and leadership. How are you passionate about this business? What's driving you? What's keeping you up at night? What's making you work rather than go sailing or boating or skiing? That's the difference. And it's that passion and leadership that can make all the difference. We've seen entrepreneurs come and pitch who really don't know a lot about business or money, but they've been so passionate about what they're doing that they get funded. My favorite example for that, probably my best example, is Michel Laberge, who founded General Fusion. General Fusion is going public this year in a big way, and having raised hundreds of millions of dollars. And General Fusion got started by $400,000 of angel money given out in this room, not this room, but in an SFU room just across the hall. And it all started because he had that enthusiastic passion about what he was doing. And then after that, everything kind of fell into place. It's a really good story. So here's where I'll stop. So I got a few slides here, which will help you with the competition. You know, when round 1 is due, I got this. I hope the website is up to date, Angie, because I just pulled it off the website last night. So, so this is round number 1. Then I've got round 2, the feasibility test. And at each of these stages, what it is that you have to present. Here's, then you get to a pitch day, and fast forward. Where's the other slide? This here. So these are the questions to address, and the following slides that I have in here, you can just look at them at your leisure, and they will help you answer some of these questions. So what we're looking for at new ventures is really something around 8 pages. You know, not the great big lengthy plan that's going to take judges and others long time to absorb, but very clear. And it's all about focusing on these basic questions and answering those questions. And do that right, and it'll open a lot of doors for you with investors as well. So I've done a lot of rambling on and talking here. Happy to answer more questions, either here in the room or online. Yes.
So demo is the required, like the product demo is required for this competition?
Angie, can you answer that? I don't think they are. Are you talking about maybe when we say we're going to have a demo day? Is that what you're thinking?
Yeah, I seen in the website, probably there was a demo day,
Yeah.
but our.
You don't have to demonstrate anything other than deliver your pitch.
Oh, okay.
Yeah.
So, get a little bit confused because our demo is under development, so we are not sure that we can finish it within 2 to 3 months. So, yeah.
You just have to talk about it. Anything else?
Hi, my name is Artem. I'm CEO and founder at Trident AI. We use AI for detect problem in your mouse and organization home, using oral camera and AI. And so we have a device and AI both. And it's like some special from medical devices or medical startup. I mean, some what we have to prepare because we have like many rules, like the many laws here in Canada, how to work with data, how to work with.
I'm not sure.
Yeah, through like for medical startup, we have some special requirements.
There are a lot of medical startups are very attractive to many angel investors. The trick is to find yourself a few that you can go to for advice. They're pretty easy to find. You'll find some tomorrow night. You will find some tomorrow night, guaranteed.
Yeah, because like these things that, as you know, like our experience shows that for medical startups, it's take more time. So
they're all different. They're all different. You know, some pharma's even worse, takes even more time, even more risky. Then you've got clean tech. Clean tech is different beast, takes a lot of capital equipment. You know, software used to be, until AI came along, very easy. And now what's coming, there was a big swing from hardware to software. People were abandoning hardware and trying to be hardware agnostic and going to software. I think that pendulum is swinging back. And what investors like is hardware with some software in it, because the software is becoming so easy now to compete against, whereas the hardware still has a little bit more of a moat. So things, you know, this industry is all. That's why I'm still an angel investor, because I learn something new every time I look at a new investment opportunity. Things are always changing. It's fun to learn about these new trends.
I think probably both wondering about this is whether investors are interested in investing in medical device companies, software or otherwise before regulatory approval.
Again, they're not homogeneous. That's take that. If you don't take anything else away, take that away. Angel investors are not a homogeneous bunch. You heard Mark and I already starting to debate about safes. I hate them. He's okay with them, right? So we're not, you know, on most things we agree, but there are areas where we're different.
Pre-seed might be more the before regulatory, seed might be after regulatory.
Actually, yesterday we have a meeting with Amazon. It's about how we keep data, so some different roles, some different certificates, like from proof, etc. And that's why I asked, like, they said that if we show that, like, we ready for two, it's better for investors because they know that, like, there's a certificate that costs around from 10,000 to 40,000, and it takes from 6 months to 1 year. And if you show that, like, we prepare from our side, it's like almost prepared, it gives our, like, more chance to uh, raise the money. That's why I asked.
Yeah,
Thank you.
I think you have the answer.
Any online?
Yes, we do have a couple online questions. We'll start with Arjun, if you wouldn't mind unmuting yourself.
Thank you. So, in your term sheets, do startups usually have like a buyback clause where once they reach an agreed upon multiple 20, 30 times your money, they can buy back the shares so they can free up the cap table? And I also wanted to ask you about diligence. What are like the common reasons startups fail to get past that process?
So your first question, say it again.
So, do startups, in your term sheets, do startups usually have like a buyback clause when once they
You
reach
mean,
yeah,
okay. You mean can startups buy back the shares that they sold to me, for example?
exactly.
I've never seen that. Have you ever seen that, Mark?
If it exists, I wouldn't go for it. Why would you, if,
Yeah.
you know, having taken all of the risk of investing, you know, in risky companies, why would you allow them, if it turns out to be moderately successful, to, you
Yeah.
know, force a buyback of your shares? That would be the old killer.
Yeah, Mark is saying that if he takes that big risk, and you're doing really, really well, he doesn't want to be forced out. He'd rather go along for the ride and cash in with you.
Deal killer.
Now there's a company that I mentioned earlier, and they're in the situation where they're doing super, super well. And what they did was they offered the angels an opportunity, but it wasn't forced. So they said, look, if you want out, we'll give you, and it happened to be 10 times your money back. They said, we'll give you 10 times your initial capital back, but you don't have to. It's optional. And so that was nice. So some people took it, older people took it because they wanted to enjoy the money, and younger people were happy to say, no, we'll stay in for the long haul. And then what was your other question? You had another question.
Yeah, once companies get to due diligence, what are common reasons they fail to pass that phase?
Well, all kinds of shit can happen, right? Your patents may not be so solid. There may be competitors. I should have said more about competitors today. Competitors are a big worry. That's who's going to eat your lunch. Not having enough money, that's another takeaway for you. If we've had a few situations where investors are so keen about a deal that entrepreneurs are raising more than they think they need. And there are a few that turn that down. And that's a big mistake. So if people are willing to give you money, take it. Never reject it, even if it means a little more so-called dilution. Because you don't want to tick them off because you may need them down the road, and you can use that extra money. But yeah, due diligence can fail on any number of things. The other thing I just want to leave you with too is, again, going back to VCs versus angels. And, with angels, it is a dating game. We talked about trustworthiness, and those things take a bit of time. So even though you may fall in love, on your first night stands, it does take a little bit of time. And I think even most angel investors, what would you say, Mark? A month or two? Like you probably wouldn't write a check in a week, right? Because you want to get to know the people.
Like you, I mean, I like to work, there's safety in numbers.
Yeah.
I like to work in groups with other angel investors that come to
Yes,
sort of syndicated deal that we all feel comfortable with. So
that's another good point. You know, angel investors come at this from different angles. One will be obsessed with finance, another with technology, and so on. And so they all ask these different questions. So they work together. And if any one of them comes up with a showstopper, that could kill the deal.
related, because you've probably seen this too, don't try the divide and conquer tactic, meaning you try to keep all of your potential angel investors separate and don't let them know who they are, so that you'll try to sort of make a better deal with each one, because we eventually all find each other.
Yes. Did you online people hear that?
Yes.
That's excellent advice. And that's so true.
We all find each other. Your divide and conquer tactic will come back to bite you.
Yeah, that's a really good point. More questions?
Marco, did you have another question? Go ahead.
Last question, then we'll wrap.
No,
Nope.
don't raise them.
That's good. Okay, well, thanks for your attention. Okay.
Yeah, sorry, I was on mute. Can you guys hear me?
Oh, he was on mute. Okay, we'll squeeze you in. We'll squeeze you in.
Sorry, just one quick question. You were talking about competition. Thank you for that. How worrying is it if an idea does not have a lot of competition in the market right now?
I've never heard of that. I think every idea has competition. I can guarantee you that there'll be somebody in a basement apartment in Poughkeepsie, Illinois, working on exactly the same thing that you're working on. It just hasn't surfaced yet.
Okay.
So you should, in fact, I think it's a good habit for you to think that there is somebody out there working on what you're working on, you know, even though you don't know about it, because there probably is. It sometimes surprises me, you know, now it's much easier with connectivity the way it is, but I remember sitting in on presentations and somebody would talk about things, and I would, while they're presenting, Google what they're talking about, and up pop all kinds of things. And I would say, have you heard of this company? Have you heard? Oh, no, never heard of that company. That's a big worry, right? So you can bet on there being competition, and very unlikely that there isn't any.
And I think you've often said status quo is also competition.
And the status quo is competition. Yeah, the existing tried and true method is your competition.
All right.
Okay, so if you guys are
Thank you.
interested in Vantech, go talk to Aaron at the back. He's got the baseball hat on. And when you're ready to look for money, talk to Mark, talk to me, talk to Aaron. Our office is right there.
I still need to sort it out, but he's offered some one-on-one consults. I can't remember what we're calling them, to support startups, so more coming, hopefully another this weekend. But Aaron is very generous with his time helping companies as well, so thank you. So thank you, Mike, again. Thank you online. So this is the first of a few different financing topics upcoming. So and everything is complimentary, but down the line, as the series continues, we have one on corporate structure, which is more around the legalities with Baskin. Then we have Ethan Poole from Spring coming to give really the whole cycle, give you an overview of capital raising from beginning through to BC. We have a session on data rooms, and more. So hopefully this is layer one, and then you'll learn more layers as we go. But otherwise, next week we'll be here for pricing in person and online. Thanks for coming. Have a nice evening, and we'll see you next time. Thanks.